more than 50% of the world's population or GDP creation, seems to be coming from these emerging economies. And by emerging economies, I'm referring to Latin America, Middle East, Northern Africa, India, and even Southeast Asia.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Anuj Mehta with us. Anuj is the India investment lead at Rise Capital, where he's leading the India investment strategy. Anuj has previous stints at Kalaari Capital and Entrepreneur First. In this episode, we talk about Anuj's story and how he started investing, facts and figures that support India as a great place to invest, most exciting sectors within India, 5 M's they use to evaluate startups, his biggest learning as a VC, and lots more. So without wasting any time, let's dive straight in. Hey Anuj, so good to have you on the VC10X podcast. How are you doing?
I'm doing great. Hi, Prashant. Thank you so much for having me here. Looking forward to our conversation today.
Yeah, pleasure to have you on the podcast. And to start things off, can we first have your story and how you started investing?
Sure. So to share some background about myself, right? So I was born to a typical Gujarati business family of diamond merchants. And when I graduated from IIT Kharagpur, I was the first one in my family to even hold a degree. Now, if I just split this statement into two more points. One is while I was since I belonged to a typical Gujarati business family, so businesses, trading, and stock investing, so mainly public equities, that was very normal in my family. And I actually got exposed to the world of public equities way before the private markets. And as a part of our family office, I used to track a lot of publicly listed companies. And then fast forward to my time at IIT Kharagpur, I never really had a mentor or a guide as to what else to do with my life. But however, being a premier technology institute, so I was able to see many of my wingmates in my hostel, talking about startups, talking about the application of technology and what role it is going to have or is it going to play in India's growth story, not only about not in the next few decades but even centuries, right? And that was actually like the inflection point. And for me, that thinking about how do I get involved into technology, right? So I had made up my mind. I'm not going to take up a typical core industry job. And also to mention, the entrepreneurial community that IIT Kharagpur had was super strong. There were a bunch of companies which had emerged out of IIT Kharagpur, and looking at our community of strong alumni who had already launched startups and they were doing very well. Some companies like Innovator or Capillary Technologies, or Porter, Black Buck, and all of these companies, like those names, just to name a few, but there are many more companies. So got inspired, by that wave, and I wanted to get into, technology or the startup ecosystem in general. And I ended up joining SoftBank-backed, Housing.com, which is a real estate, startup, and I joined their operations and strategy team. So that really gave me a window, into the startup ecosystem. I got to appreciate the daily chaos that takes place, on the startup floor, and appreciate what a founder goes through, the daily nuances, that are there in running any startup. I was able to understand those, at a grassroots level, and then post my, Housing.com stint, I thought, why to just restrict yourself to a singular company or a singular sector? Why not have like a bird's eye view of the entire Indian ecosystem? And if at all there was an opportunity to work with not just one, but multiple companies simultaneously, be able to learn about multiple sectors simultaneously. And the answer to that question, after doing a bit of introspection was, venture capital. Now I had to figure out, how I, break into venture capital. And this is back in like 2015, 2016. When that was like the first crazy wave of venture capital financing into India. SoftBank had also made a couple of investments, And I was fortunate enough to get a break into the seed investment arm of Kalaari Capital, one of the homegrown, early stage funds in India. So was fortunate enough to join that team, and the first project that was given to me during my time there was to build out the investment thesis in the gaming sector, source opportunities and lead investments, and that actually came as a surprise. And yeah, and that's how I got exposed to the world of venture capital. And then one thing just led to the other, and since then I've been associated with a bunch of accelerators and funds. Post that, I was even a part of Greylock Partners backed and founders backed Entrepreneur First, which is a London headquartered talent investor. I was responsible for launching their India operations and helping them with the accelerator operations, as well as developing their funding networks in India. And then yeah, so that was my exposure to the accelerator world. And currently, I'm associated with Rise Capital.
Absolutely. So now let's continue this story with Rise Capital. So, what's been your role at Rise Capital, and what are the kind of things that you're investing in, being the India head?
Sure. So at Rise Capital, our investment thesis mainly revolves around emerging economies, right? And emerging economies or markets are super attractive to us. And the main reason being that, the world's more than, 50% of the world's population or GDP creation, seems to be coming from these emerging economies. And by emerging economies, I'm referring to Latin America, Middle East, Northern Africa, India, and even Southeast Asia. So, the point is that even though more than 50% of the world's population GDP, seems to be in the emerging economies, but however, less than 15% of the venture capital money has actually flown into India, and that is actually a huge imbalance. And I would say that a lot of unallocation is there, when we are talking about emerging economies, and that is a massive opportunity that Rise Capital sees when it comes to the venture capital model, and hence we are super, long or bullish about emerging economies. And and in current times, India is a geography that is there on almost every VC's roadmap, and so I've been fortunate enough to track India for Rise Capital, source opportunities, work very closely with the portfolio in India of ours. And yeah, so that's what has been, keeping me going as of now.
Right, that's great. And you worked in India through and through, starting from housing.com, which was one of the leading startups back then, right? And then coming on to the VC side, the other side of the table, and working with VC firms, Kalaari, one of the leading VCs in India, and then Accelerator, Entrepreneur First, right, which is pretty new in India, helping them get a foothold in the Indian market, and now at Rise Capital again, focusing on India. So how do you look at the Indian market, and how has it evolved over maybe the past 5 years, and where do you see it going in the next 5 or 10 years?
Sure. So I would say India has been at an inflection point. And if we just look at the firstly, let's look at the last 2 years, during COVID time. And the number of unicorns that India produced is far more than the number of, unicorns that were produced in China. It is important to note that, that less than 1/3 of the capital compared to China actually went into India. And ideally, this shouldn't be the scenario, because Chinese companies actually, have been building for China. But on the other hand, the Indian companies are actually scaling globally, and they're building for the world, right? And that is actually a very big, mismatch. And even on an adjusted, GDP basis, compared to USA, for every $5 that has gone into US, only $1 has gone into India, right? And now to talk about the India's GDP so far. So to give you some stats, $3.5 trillion GDP. This is the number for the GDP that India has been able to create in its entire history, right? And it is mind-boggling to know that that an equal amount of GDP is going to get generated in the next 5 to 7 years in India, right? And the major contribution for that $3.5 trillion GDP is going to come from the digital economy. It is very clear, right? So,
Yeah.
and actually, we as Indians should, like take a moment to fathom the fact that this is the scale at which India has been growing, right? And now to compare the digital economy's contribution to the GDP, right? So let's say in the last 7 years, since 2015, about 250, about $130 billion have actually flown, from global investors into India, right? And now, if you look at the digital economy's value creation, that is approximately 250 to $300 billion. Now, if you take a percentage of the digital economy's contribution as a part of the total GDP, that is about, I would say, about 5.7% or 6%, when it comes to India. Now, if you compare that with China, it is at about 20%. If you compare that with USA, that is, I would say, it is at about 35 to 40%. So you can imagine the untapped opportunity that lies ahead of us here, sitting here in India, right? So that is actually one point. And if you see at the total valuation that I already shared with you, about like $250 billion, about a decade ago, that was almost negligible. And this value creation has come actually out of nowhere,
Yep.
right? And from 500K jobs in the digital economy, in the next 5 to 7 years, we are going to see that number rise to about 5 million. Now, to share some more, facts around, the Indian startup ecosystem. So it enjoys a very strong, demographic, advantage, and that is that more than 600 million, Indians have an average age of less than 28. So, which is basically a very young, demographic, and all of these individuals have actually
Right.
grown up being exposed to internet, right? So that is one point.
Right.
The other one being the Indian talent pool, world class technical, super technical talent, coming out of Indian universities, and they are super hungry, relentless, to build companies setting out of India. The brain drain problem also seems to have been solved. So there was a time where everybody used to, leave India in search of opportunities, but we are actually seeing the reverse, happening now. Many of, the Indians located globally, they are actually wanting to come back to India, or let's say they have even been impacted. The technical talent has been impacted by the recent layoffs at, large corporations at, mostly the FANG, and they are actually wanting to start their own ventures, right? And that is a good opportunity for the Indian startup ecosystem. So they're coming back to India and now launching startups, right? And and people in India, they are wanting to stay in India and not go outside India. So that is actually a very good opportunity, I would say, sitting here in India. And if we look at the internet base, so India has an internet base of about 932 million. However, only 7% of the total internet users have actually made a transaction online, or they have been involved in e-commerce. So you can imagine the under penetration that still exists in India. So there is such a large untapped opportunity, ahead of us, and of course, needless to talk about, the aspirational middle class, in India. Many of them wanting to, improve their lifestyle. Their earning capabilities have increased, and and that will be a massive opportunity for the consumer startups, going ahead.
Yep. Yeah, I totally agree to that, and very, very insightful and filled with facts and figures answered there, pushing the fact that India is the next big thing, and we've heard it on the podcast several times. And Anuj just pressed that and nailed it further, right? And now let's talk. We are convinced, very much convinced, that India is the place to be. Now let's talk about what are the most exciting sectors, as per your opinion, within India.
Yeah. So, I'm going to answer this question a little differently, right? And, to start off with an answer to this question, there are different flavors to different seasons. And currently, generative AI is the hottest, flavor of the season. And to be very honest, if you dig in a little deeper, there was nothing new about AI. Actually, AI was there back in 2017, 2018 also, and maybe the startups back then weren't getting funded at that pace. But now, with the meteoric rise of OpenAI's ChatGPT and its mind-boggling usage, all investors and all entrepreneurs are suddenly, talking about, generative AI, right? And similarly, if you look at the COVID boom, so education or edtech, was super hot, during COVID time, and all investors and all entrepreneurs chasing edtech. But now, in current scenario, sitting here, in 2023, if you talk about edtech, among the investor community, most of them are going to shy away, from education. At least that's been the sentiment, in my network, right? And last year, the cross border B2B commerce or B2B marketplace, was the flavor of the season. So to be honest with you, these sectors, being hot or being like an investor's favorite, that is also cyclical, just like how the economy is also cyclical, and they keep changing. But now, at a personal front, I have been spending a lot of time reading about, learning from my interactions with founders across sectors like, Web3, creator economy, climate technology, and of course, generative AI, right? So these are the sectors where I'm spending most of my time, because I need to upskill myself in terms of what are the latest trends that are taking place among these sectors, right? So that's where most of my time is being spent. But however, having shared whatever I shared, I'm super bullish, and I personally believe that the next wave of Indian unicorns will still come from the evergreen, not so fancy, perennial sectors like healthcare, fintech, SaaS, and even gaming to a very large extent, right? So there's nothing new about these sectors, but the sectors that I mentioned to you in the beginning, they are like super new, so they will sound fancy to you. But I believe that the next wave of unicorns will still come from these perennial sectors that I shared with you.
Yeah. Yeah, that's great. And now let's talk about how do you evaluate these companies? You have had a good track record of betting on the right companies. So how do you do that? And what are the kind of things you're looking at when you're evaluating a deal?
Sure. So, to answer this question, let me walk you through, a framework, and we call it the 5 M's, right? And 5 M's, where each M stands, for a certain parameter. And I'll walk you through these parameters. So the first one is management, where we are basically looking at, the founders, who are working on, the startup. And there we try to deep dive into the complementary skill sets that these founders have, or if there is an edge that they have in terms of the domain. Let's say if an individual has spent more than a decade in a particular industry, whether it's logistics or healthcare, and if that individual is starting up in their respective industry, so that individual definitely has an edge over somebody like you or me, where we have not been exposed to those industries at a granular level. And the learnings that they would have, with regards to the macro as well as the micro trends, will be far more superior, and they will be able to implement, those learnings into, the startup that they're working on. Complementary skill sets, by what I mean by that is, let's say, if there are two co-founders, one of them takes care of, let's say, the business side of things, operations, strategy, sales, business development, and on the other hand, if there is a co-founder looking at the product and the tech side, so that's a really good mix to have, right? So that's one, I would say, like a sub point within the management point. And the other one would be whether they have had past or previous operating experience, and how quickly they are able to showcase I would say outcomes or results, right, working on that particular problem. That's there. And then I think it's even a factor of intangibles, Like you speak to somebody, there is a very different kind of spark. You can sense that magic, while interacting with a certain individual, and you just feel that there is some wow element, about this. There is, and that's why it's called intangible, right? So that is also a parameter, I would say, sub parameter, which gets factored into while evaluating the management teams. So that being the first point. And the second one, to continue, with this response to continue, right? So the second parameter is the market opportunity or the market size. Now, how large of a market, that the startup is actually going after? The questions that, I like to ask myself is that, can this startup, produce like a GMV of like $5 billion, maybe let's say 5 years or 10 years down the line, that large of an opportunity. And even to evaluate the competitive landscape, right? Who are the other incumbents? How heavily funded, these other players are in that particular, market, right? So that also needs to get baked in as a part of the, evaluation. Third one would be metrics. What are the financials that this company is seeing? What does the margin profile look like? And how quickly, let's say if a company does not have, financial metrics, but definitely there'll be some operating metrics that, or KPIs that this, startup would have. So it becomes important to evaluate, how quickly, or let's say at a month on month level or a quarter on quarter growth, that startup is able to showcase. Whether it is like, if it is like doubling, month on month, that is really like a good metric to have, right? And it could be any XYZ metric depending upon the sector and the business model that the startup has, right? So the third one is definitely metrics. The fourth one would be moat. Is there, the question that we ask is there an IP or a technology moat that this company has? How hard would it be for, another startup to actually, build out a similar technology? That is like, one aspect. Does the company have like network effects? And maybe at economies of scale, or like, how the margin profile is also going to like kind of, pan out, and whether the startup enjoys the economies of scale actually. So that also needs to get baked into, the moat. If whether, let's say if you're evaluating like a consumer brand, how strong, how strong the affinity, for the brand is, right? So that is also a part of the moat evaluation. And moving on, so the fifth parameter would be the multiple of money, right? It becomes very important to assess the valuation at which, one is, investing. And for that, it is always, I would say, it's about relative valuation. So we like to look at peers, and the valuation divided by, the revenue, at what valuation multiples did their peers raise. And we actually even, look at publicly listed companies in that particular sector and see that in a steady state, what is the valuation multiple at which, that company XYZ is trading, and then try to assess that whether this is too expensive of a deal to get into, or whether it is a cheap deal to get into. And then from an investor's approach, we try to, gauge that, whether this opportunity can, help us generate like at least like a, 10 to 20x kind of a return, or whether it is like a 5 to 10x kind of a return, or whether it's like a 100x kind of a return, whether if you're investing at a pre-seed or a kind of seed kind of a stage, right? So yeah, so I think the fifth parameter that goes into this evaluation is the multiple of money. So yeah, so the 5M framework is actually, I would say, like a combination of these 5Ms, right? So as I already shared with you.
Yeah, that's great. And now let's, since you mentioned about valuations and multiples, so right now we are in between a downturn, right? And valuations are kind of getting tricky to what's the multiple that you should raise at, what's the correct valuation, and was the valuation different for maybe 2 years back? Is it now calculated differently? So how should maybe founders navigate the downturn and think about valuation at this point of time?
Interesting question, right? So, I mean, I can have, multiple, I would say, cuts, multiple cuts to this, answer. But, I'll tell you that booms and bust,
right? They are a feature of this ecosystem. They are not a bug. Okay. And many founders that I speak to, they tell me that the times that we are going through currently, they are abnormal. And I tell them this is not abnormal. What happened in the last 2 years, that is abnormal. That we saw like crazy amount of funding going into the ecosystem, and that was abnormal. So I would say this is like a reboot that is taking place right now, and this is what is happening here. It is actually not abnormal. What took place in the last 2 years, that was abnormal. And to evaluate any ecosystem, I go by the 3 V's. And by these 3 V's, I'm talking about volume, the velocity, and the valuation. So by these 3 V's, you can actually evaluate how the ecosystem is moving forward, right? And by volumes, if we compare, let's say, the Indian ecosystem with the US ecosystem, it was only during COVID times we saw that the valuations of Indian companies and the amount, whether it is at seed stage, Series A or Series B stage, so that quantum was, I would say, measurable, with the US counterparts, right? And so that seemed a little like that should ideally seem a little abnormal, to I would say to any player in this ecosystem, right? That something seems to be off. How can Indian startups raise at the same valuation, raise similar quantum? And to talk about velocity, I think some of the investors, I would say like they just increase or ramped up the velocity. Like we have seen some investors, invest in up to 100, startups on an annual basis. And that number is far high, that than what they did pre-COVID. And to just take a step back, when COVID hit, nobody knew what was going to happen. Everybody thought that this world is going to end. And, leaving aside the first 6 months of the pandemic, right? And what actually happened in the next 1.5 years post those 6 months, nobody had ever anticipated that that it's going to get this crazy. It's going to get this crazy, and we're going to see all the 3 V's really shoot up, right? And now to talk about the advice, I would say the startups, they need to be super scrappy. They need to go into a cockroach mode. And what I mean by cockroach mode is that they need to really work on their survival and sustainability. There is no shame in reducing founder salaries. Firstly, founders should not if there is actually like a capital crunch, founders should reduce or not take salaries. That's one aspect. And I've seen so many founders spend so much of their resources, whether it is capital or time, energy, sweat, going into things which do not necessarily move the needle when it comes to growth, right? So I think they need to relook at the strategy when it comes to their bandwidth allocation, right? And they need to speak to their customers daily. They need to speak to their employees daily. They need to be super transparent, with all the stakeholders, involved in the startup journey. And and I think these are like some of the advices that I would have, for the startup founders. But to add on to this point, I personally, as an investor, I feel this is like a blessing in disguise. The timing, that we are going through. This is ideally the best time to build, right? And now imagine yourself as an entrepreneur, during COVID times, where the 3 V's that I spoke about, all of them were at their all-time high. There's just so much noise, right? And how can one really focus on really building a startup, right? And I think this is a good time where the noise has gone down, the valuations are realistic. And I think this is like a tough time, but I think the best of the entrepreneurs will really emerge, and they'll be tested through this time. And actually as a part of the COVID induced funding, right? So there were a bunch of startups who raised a lot of capital at unrealistic valuations, right? So I personally feel that these founders should not get caught up, in these mental shackles of trying to match up to the unrealistic, valuations. I think it's okay to raise even at a down valuation. See, the end customer doesn't care about your valuation. Your employees who get like an X amount of salary on a monthly basis, they don't care about the down valuation. They'll be happy if their if the next funding round is closed, even if it is at a lower valuation. They will be happier, and maybe that will give all of these startups enough runway to build out sustainability and work on their unit economics, right? And there are broadly three different type of companies that we are coming across. One is
Right.
those companies who have raised a lot of capital but have not been able to achieve the PMF. And right, so I think the question that they need to ask is whether they are working on a really large market opportunity. The second question that they need to ask is whether they have have a competitive advantage, and the tech that they are building is not commoditized, right? There's some uniqueness or disruption. And then if these two questions, or the answer to these questions is a yes, then they need to think about whether they have enough capital for the next 15 to 18 months to survive this downturn, right? And let's say if the answer is no, if the answer to the first two parts to this question is yes, but the answer to the third part, which is capital, if that is a no, and if they're running out of capital, I think it is okay to raise at a down valuation. Now let's say if there are companies where the founders, since they are working on this statement or problem statement, and they're working on their offering, they get to know much more before, I would say, in advance. And if they are able to identify that this company might never achieve PMF. And there were a bunch of companies where they had a COVID induced PMF. And now what has happened is that since that COVID induced demand has gone away, so these companies with no PMF have gotten exposed, right? And let's say if all the stakeholders are of the agreement that that this startup is not going to work out, I think it just makes sense to return the capital, whatever remaining capital that a startup has. It makes sense to return that capital back to the investors, because the opportunity cost of working and spending time and bandwidth on something which is not going to reap actual benefits or fruits in the long term, I think is way too high than being caught up working on something that might not really work out.
Right. Yeah, I totally agree to that. And now let's move on to my last main question before we move to the rapid fire round. And this one is about what's something you've learned now in your venture career that you wish you had learned at the start of your venture career.
Sure. So the answer to this question is empathy. Okay, it is more of an emotional, or I would say it's psychological in nature. And I'll tell you the reason for this. I think it's purely because we as investors are just putting in capital, and that also not our own capital. We are putting in LP capital, and we are managing it on their behalf. It's actually the founders, who are going out there, working on their startups, putting in their everything, their time, energy, resources, blood, sweat, even putting their relationships on the line, the family, investing their own capital as well, right? And for us as investors, a startup investment is just, I would say, it is just one of the many portfolio companies. But for the entrepreneur, this is their everything. They have put everything on the line, like to work on this startup. And we as investors are nobody to decide somebody's future. And all of these facts, actually, if you look at it, these facts should be humbling and not make an investor arrogant or elusive in a way that, I'm sitting on some pile of cash, I'm an investor, and I decide somebody else's fate. That is totally wrong, right? And so that is one learning, I would say. It has been empathy, which I have learned. The other one being, I would say, building your own conviction. there are so many micro VC funds and so many other early stage funds that have that have emerged, and they tend to piggyback on somebody else's conviction. Let's say if like an XYZ globally reputed fund is investing in it, a micro VC would also be interested in tagging along, right? And if you look at the portfolio performance or fund performance of even globally reputed funds, even they have not so well performing portfolio companies, right? So I think it just doesn't make sense to borrow anybody else's conviction, rather build your own conviction. So even if it fails, you have nobody else to put the blame on.
Yeah, I totally agree with that. And now let's do the rapid fire round, wherein I'll
Sure.
ask you 5 quick questions about the fund, and you have to give 5 quick answers. Sounds good?
Sure.
All right. So the first one goes: what are the sectors and regions you invest in?
So sectors, I would say we are sector agnostic. Anything that leverages technology. In terms of geographies, all emerging markets: Latin America, Middle East, Africa, India, Southeast Asia.
Great. And what's the typical stage of investment?
So at Rise Capital, all of us have been operators or entrepreneurs in the past. We like to get our hands dirty, and having said that, we like to get in at early stage. So whether it's seed, Series A, or Series B stage.
Got it. And what's the typical check size you put in?
Anywhere from 100K to $10 million.
Got it. And where can founders apply for funding in case there is a direct way?
So we are pretty approachable. Anybody can reach out to us on LinkedIn. I have even put out my email on my LinkedIn, so anybody can reach out to me even via email.
Great. And where can our listeners follow you?
So we, being a venture capital fund, our focus has never gone into content production. So we are not a media, we are not a media company. And I think the best way for listeners to follow us is to reach out to us, schedule a call, and then they'll get to listen to us.
Right. That's great. I'll make sure to put all the links that you mentioned in the show notes below, even your email. And thank you for coming on. Happy investing.
Thank you so much, Prashant, for hosting me. It's been a pleasure.
Likewise, pleasure hosting you. Thank you for time.